we're going to look at a couple of different transactions and how to record them regarding the issuance of stock, both the common stock and preferred stock. The first transaction is that Acme Corporation issued 20,000 shares of $1 par common stock for $9 per share. Now, the par value, that's just the stated value established for a share of stock. The $9, that represents the market price, what a willing party is willing to pay for that stock. So the first part, we have to ask, well, what did the company receive in that transaction? Well, they got cash. They got $9 per share, and they sold 20,000 shares of common stock. So the first part of the transaction is saying that we receive cash. You take 20,000 times the market price, what a willing party was willing to pay for it, and that means we receive $180,000 of cash, and we're going to debit the cash account for $180,000. What did we give up? Well, we gave up common stock that had a $1 par value, and we gave up 20,000 shares of that. So what we're going to credit is common stock, 20,000 shares times $1, or a credit of $20,000. When we list the sale of stock, we're always going to record it at its par value times the number of shares that we sold. Well, we have a problem at this point. Our debits don't equal our credits. We have a $180,000 debit. We only have a $20,000 credit. So we have this new account called Additional Paid-in Capital, common stock, and this represents kind of the plug number, or the additional amount that people were willing to pay above the par value for that stock. We have a $180,000 debit. We need $180,000 on the credit side. We already have $20,000 for the par value of the stock. So the additional paid-in capital is just the difference between the $180,000 and the $20,000, or $160,000. So debit cash for $180,000, credit common stock for $20,000, and we're going to credit additional paid-in capital of $160,000. For any transaction with our common stock, we're always going to be using this account as the kind of adjustment factor, the difference between what we received and the common stock at its par. The next transaction is dealing with preferred stock. And preferred stock has a stated value on it because it has a value, and then it's going to also say what the amount of the dividend would be. Because it's preferred, it has a stated amount. So in this example, Ajax Incorporated issued 10,000 shares of $25 preferred stock for $30 per share. Now, when you read through that, it can sound kind of confusing, but the $25 preferred stock, that just means that's the stated value on the share of stock. That's the amount that's on there that they're going to calculate the dividend as maybe a percentage of that. But just like we had with the common stock, the preferred stock can be sold at a higher or lower price than that. In this case, people were willing to pay $30 for that share of preferred stock. We ask ourselves, what did we receive? Well, we received cash at $30 per share times 10,000 shares that we've sold. So we're going to debit cash for $300,000, and the calculation is here in parentheses, $30 times 10,000 shares. What did we give up? We gave up preferred stock. At its stated value of $25 per share times 10,000 shares, or $250,000. So that's going to be our credit. Again, our debits don't equal our credits. We're out of balance. This isn't a complete journal entry at this point. We need another $50,000 on this side. Well, we're going to use our additional paid-in capital account, meaning the additional amount paid in above the stated value. And this is additional paid-in capital preferred stock. We're going to designate it separately than the common stock because this is attached to the preferred stock. It belongs with it. So we'll have two separate accounts depending on what type of transaction, whether it's common stock or preferred stock, and we'll have a different additional paid-in capital account associated with each one of those. So we're going to credit this account for the remaining $50,000, and now we have a good journal entry. Cash debit of $300,000, preferred stock credit of $250,000, and additional paid-in capital preferred stock, the remaining $50,000 credit.